Hello, everybody. So today I'm going to talk specifically about retail stores. So this would be anybody with a traditional brick and mortar store, or anybody selling goods online through any marketplaces or their own websites such as Shopify, Amazon, eBay, Etsy, etc. So I get a lot of questions about inventory tracking. What's the risk? What are the different options? And how to write it off in taxes. So I wanted to address that specifically. So there's a couple of things at play there. So the first thing is the government has labeled any business that makes less than $27 million in revenue over 3 years. Well, on average for 3 years. So meaning you would have to make more than 27,000 or 27 million in revenue for 3 years in a row. Anybody that does less than that is considered a small business. And small businesses get the benefit of being able to elect or decide what kind of accounting or how they want what type of reports they want to do for taxes. And what I mean by that, that's kind of messy how I said that. What I'm talking about is it's called cash basis or accrual basis or a modified accrual basis form of accounting. Well, what does that mean? Well, cash basis is basically cash comes into the bank, we count that as revenue. Cash leaves the bank, we count that as an expense. Um, Accrual basis is the idea that you've signed a contract with somebody to perform work and they've paid you. So it's considered income because you have an invoice and a signed contract. Uh, Whether or not actual cash has been received yet or not. And same thing with expenses. So you might have a purchase order, um, and because cash hasn't officially left the bank account yet, you count it as an expense because you have a contract to pay something already. So that results from accounts payable and accounts receivable. That's accrual basis. A modified accrual basis is basically we pick and choose what we want to do. And that's the benefit of being a small business, especially a really small business, is we can really decide how we want to file and pay our taxes and what basis of accounting we want to do, whether it's accrual, cash, or some sort of mix. All right, so why is that important? As a small business, it is best to do cash basis accounting. It's easy, doesn't require a lot of reports. It makes bookkeeping easier because it's literally cash in the bank, cash out of the bank, and then we verify it through proper accounting records. Well, the problem with that when it comes to inventory is we also want to try to match our expenses to our revenue. That way, you bring in revenue, you have a direct expense, so you lower your taxes based on that expense that's directly related to it. Why is this an issue with inventory? Because what happens is when you purchase inventory, cash leaves your bank account. Well, under a full cash basis, that's an expense right there. But you have that inventory, you haven't sold it yet. And so when you sell it, it's now going to result in revenue when you sell it. So what will happen is under a cash basis accounting, let's use a scenario. Let's say in December of year one, you buy $50,000 of inventory. And in year one, we write off all that inventory because we're under cash basis of accounting. So you lower your taxable income by $50,000. And then let's say you sell that inventory for, I don't know, times three or whatever. So basically you would make what, $150,000 on it or something in revenue. But let's say in year two, the economy changes, and for whatever reason, your expectations or your, whatever, your statistics or whatever, you don't sell. You sell all that inventory, but it takes you all year to sell it. So then you don't buy any new inventory in year two. Well, that means you've created a $50,000 deduction in year one, But in year 2, you now report $150,000 of revenue with no additional deductions. So what happens is we get this roller coaster effect of taxes. We have very low taxes, and then in year 1, and then in year 2 we have really high taxes. Um, and so that's kind of the problem, is we have this roller coaster effect, and the goal is that we want to try to average that out as best as possible so that we pay the least amount of taxes overall. And we do that by matching the cost of the inventory to when we sell it, and so that would become a modified accrual basis of accounting. And what does that mean? So that means that we would say, okay, we bought $50,000 of inventory in December in year 1, but we don't report it as sold yet. That's not an expense. It's not a reduction in our taxes. And so then what happens is every time we sell a unit in year 2, we would say, okay, I made $3 and I have $1 of expense. So then I actually have a $2 profit. Gross profit is the correct term. And so then what happens is instead of reporting $150,000 of revenue with no expenses, we now report $150,000 of revenue, $50,000 of expenses, and then we only have a $100,000 profit. So that's a better way to do it, because now we've matched the expense to the revenue, and we actually lower our overall taxes that way. Cash basis works the first year you do it, because you have this huge expense, but then later you don't have the expense to lower the revenue. So what happens is we can continue to do cash basis until all of a sudden you can't. There's always some sort of reason why we can't, whether you've grown to the point where you're over 27 million and so now you legally can't report cash basis, or the economy changes, something happens to your business, and suddenly it just comes collapsing down. Because what will end up happening is, basically, I consider it to like children in a schoolyard at elementary school, where they like to make a snowman after it snows. And so you start this snowball and you start rolling it and rolling it and rolling it. It just gets bigger and bigger and bigger until eventually it collapses. And that's what happens is you might, if you're taking cash basis stance on inventory, you're going to go, well, I need to buy more inventory, I need to buy more inventory, I need to buy more inventory, to keep creating those expenses to lower your taxes. And then at some point that snowball is going to crash, and you're going to owe a lot of taxes, because you can't sustain that forever. Okay, so that's kind of the general idea between cash and accrual. So we do prefer a modified accrual. Well, how do we calculate that? So this is a very condensed version. So when we talk about inventory management and accounting for inventory, that is basically a junior level bachelor's degree class that's an entire semester long. Like, there's a lot of nuances into it, but really basically there is a formula. And maybe I can share my screen here and show kind of what this formula is. It's just basic algebra is what it is. And I'll go ahead and create this formula if I can get this to open up. Okay, so let me go ahead and share screen. Let's see, here we go. Okay, so sharing screen here, this is an Excel. So basically the formula goes, and you can Google this, you can find this all over. This is the basic formula for calculating inventory for taxes or any accounting, bookkeeping whatsoever. So you have your beginning inventory, and this would be like usually what you have carried over from the prior year or the prior month. So this would be unsold inventory you have on hand as of the first of whatever the period is, so January 1st of the year. And then you're going to add in your purchases. So this will be your purchases throughout the year or throughout the period. So let's say we have $10,000 in inventory carried over from the prior year. And let's say throughout the year, we purchased $50,000 of inventory. So that's going to give us goods available for sell. So we have $60,000 worth of goods that we can sell for the year. Then we're going to say, okay, well, I'm not going to if I don't have a very good inventory tracking system, then what I'm going to do is I'm going to go in on December 31st or approximately around that date, and I'm going to count the number of units I still have available as of the last day of the year. Brick and mortar stores do physical counts. A lot of times we pull this number from inventory tracking systems, which I'll talk about here in just a second. But basically, we have our ending inventory count. And let's say our ending inventory count says that we have $25,000 of goods left at the end of the year. So then that means and we're going to subtract that. So goods available for sale less ending inventory count gives me cost of goods sold. So this is what our actual expense is for the year. And that's our basic formula. So we're going to say that we sold $35,000 worth of inventory throughout the year. So then I get a lot of questions. Well, if you're using this basic formula, how do we count for like obsolete inventory? How do we count for inventory that got stolen? We had shrinkage, we have stuff that got broken, we had shipping problems, whatever, right? So this was carried over. So this is where do I get these numbers from? So this comes from your last year's tax return, prior year tax return. Where does the purchases come from? Invoices or cash leaving the bank. That's where that comes from. Goods available for sale. That's just a formula. Ending inventory count. It's kind of like what I told you. This comes from a physical count, or from an inventory tracking system. Okay, and then that gives me cost of goods sold. Well, in theory, if you do a physical count at the last day of the year, these all come from, these two numbers up here come from actual justified correct numbers. So if you go and you do an actual physical count and you say, Jason, this is the amount of inventory I have available, then this formula is going to say, okay, any shrinkage you had or obsolete inventory, any inventory not there, gets calculated in this formula without me specifically identifying it. So that's how you can still account for theft and shrinkage and obsolete inventory, or even inventory you just took to the Goodwill and dropped off. It's not there at the end of the year, so it gets accounted for. So no, you might not have actually sold $35,000 worth of inventory, but all those other things are still expenses that are going to get figured into this number. Okay, so that's how it's a catch-all formula for all those things. So that's how we're able to accurately get you a correct expense. Now, that's not going to be broken out. That's not going to say, oh, you have $10,000 of inventory that was obsolete and you weren't able to sell it, so you took it to Goodwill. I don't break that out, but it is accounted for in that number. Okay, so that's kind of the basic formula. Okay, so now let's talk about inventory tracking systems. So one of the ones that I have a lot of people use is called Inventory Lab. So I'm going to pull this up. And let's go look at pricing. So the base model, or you get a whole bunch of reports, is $69 a month, or almost $94 a month if you get all the reports. Okay, so that's how much Inventory Labs cost. When we're talking about large retail stores, so I was the accounting department manager for a large retail store while I was starting my firm on the side, 10, 15 years ago. We had an inventory tracking system. This company was making about $750 million a year in sales. Our inventory tracking system, I think, was over $500,000 a year. A store like Walmart or Macy's, or you pick retail store, especially if they're a Fortune 500 retail store, their inventory tracking system is costing millions and millions of dollars. And the thing that I learned when I was working for this company was that at any given point, our inventory tracking system at its best was probably 90% accurate if we were lucky. So now let's look at something like Inventory Labs, which is a small fries what we can afford. And they're charging us $69 a month. This is not an accurate inventory tracking system. It is an estimate at best. Um, okay, so what does that mean? No matter how much information you put into this and how much you try to keep it accurate, it is still not going to give you a physical count at the end of the year. Nobody is going into the warehouse, especially if you're selling in like Amazon FBA and your inventory is all over the country. Right? Nobody's going to do a physical count for you and tell you this is what's available. So we're using estimated reports based on information that you've entered. And you know what? Some days you forget. We have human error. And so at best, these reports are probably 80% or 70% accurate. They're always an estimate. Well, it's not that big a deal because here's what happens. Let's go back to our formula. Ending inventory, this physical ending inventory count, this 25,000, that becomes the next year's beginning inventory number. Okay, so this is always a rolling formula. If we miss something in year one, it's going to get found or accounted for in year two because it's always an estimate that's a catch-all formula. And there's no need like, we discovered that inventory labs was incorrect, which we do all the time because it's not a very good software to begin with. It works, but it's not great. It's going to get caught in the next year, and then you go, oh, okay, well, we're going to have a, let's say instead of $15 or $25,000 in ending inventory, we actually had 15,000. Well, that means, oh, well, then we're just going to increase cost of goods sold for year two by $10,000. So it's always going to be an estimate. It's always going to be fluid, and it's always going to be carried forward, and it's always going to get corrected at some point. Because what's going to happen is if you continually have bad inventory tracking, what we're going to see is this ending inventory count is going to continually rise. It's going to go up, and at some point in a couple of years, we're going to go, why do you have $500,000 of inventory on hand? Are you not selling it? Oh yeah, I'm selling it. Okay, well, we have bad inventory tracking system. Let's make a correction, and you're going to report a loss for year 5 because we discovered an error. Okay, so the IRS understands this. This is anybody that's worked in retail as an accountant, CPA, the IRS that's doing audits in this, have background in this. We all understand this formula, and we all understand it's an estimate. And so no one is going to make you amend prior tax returns for a correction in inventory because it is a timing issue. That's what we call it. It's a timing issue. It might not have been correctly expensed today, but it will be correctly expensed in the future. It'll get caught. The other thing about that is because we're small businesses and maybe you can't even afford this $70 a month, we don't care because it's always an estimate. And so the estimate can then become, well, maybe I know that I buy inventory at $1 and I sell it for $3. So what is that, 30% or something? So I'm going to estimate cost of goods sold to be 30% of my sales. So that's another actual legitimate method that we can use to calculate your inventory, your ending inventory. So how would that change things? Well, we don't know ending inventory, but we're going to calculate cost of goods sold at 30% of sales. Well, then I just back into the ending inventory because it's just all a basic linear algebra. I can't even say it. Algebra formula. I think this falls into pre-algebra, like A plus B equals C, solve for C. That's all we're doing. And so if you don't even have an inventory tracking system, then we can estimate it another way. So what does the IRS actually say when it comes to proper ways to account for inventory? Any reasonable method. Well, what's a reasonable method? Basically, what they're wanting is consistency. So if you want inventory labs to help you track your own numbers and help you have a better understanding because you can pull reports or whatever, then we're going to use inventory labs because it's going to be the first thing the IRS wants to see when they audit you because there's always going to be that report. So they want to just make sure you're keeping consistency because they know it's a timing issue. And if it's wrong, that's okay. It'll get fixed later. If you don't have inventory labs or another inventory tracking system and you're using we're estimating at 30% of sales, then that's a reasonable method. We're small. We can't afford a tracking system. That's fine. So these are some of the things you need to consider when it comes to inventory. Inventory is a very complicated accounting issue. Um, we do have a basic formula to make sure we catch it all. And it's always a timing issue so that even if there is an issue, it can get found later and it will be taken later. Um, Third thing is if we don't do an accrual basis, so this formula is accrual, we're accounting for the expense and applying it to the revenue at the same time. If you don't use accrual basis, that means you're using a cash basis. You're creating a snowball that's eventually going to break, and you're going to have a year where you have a lot of revenue and no expenses. So I see it happen all the time. Okay, so those are kind of the basic concepts with inventory tracking. Um, so really, what it comes down to is if you want inventory labs, great, or another system, it's really just for your warm and fuzzy to help you better understand the numbers. We'll use it if you have it. If you don't, we use another reasonable method. Okay, yeah, I hope if you have any questions, put them in the comments. I hope this was helpful. Good luck. Retail can be hard. Okay, see you later.